Welcome back to Turning Hard Times to Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me once again Alasdair Macleod, who is certainly one of the most frequent guests in this show by popular demand, no doubt about that. And so thanks for joining me again, Alasdair.
That's very much my pleasure, Jay.
It's always good to have you with us, and because of your insights in the markets, and not only, anybody can see this is going up and that's going down and this is going sideways, but why are they, what's behind, what's driving the markets so that we can understand and maybe plan for the future. But I want to talk to you about an article that you've written on August 13th. But before we get to that, I'd like to ask you again maybe to review for our listeners the repo market problems that occurred last September and why that's important even now.
Yes, we've almost forgotten that we had liquidity problems in the banking system as early as September last year. And to refresh your listeners' minds, basically the repo rate, which basically is short-term borrowing, if you like, short-term liquidity borrowing, it leapt up to about 10% early in September. And the Fed had to intervene because obviously if you've got overnight money running at 10%, that stands in a huge contrast against the Fed funds rate, which at that time was something like 1.5% to 2%. I can't remember the exact level, but it was a big, big difference and it needed sorting. So the Fed stepped in and started supplying the market. Now, we never quite knew why it was that there was suddenly this huge, great liquidity problem. I mean, I noted at the time that it happened on the day when Deutsche Bank sold its prime brokerage to BNP. Now, it's quite possible that the hedge funds didn't go with the accounts, and the result was that there was a shortage for either one of those banks or possibly both of those banks that led to that spike in rates. But it took a long time to sort out. And we should note that when banks have liquidity problems, this becomes extremely serious. And not only that, but you have the possibility, and it becomes very possible, that you could be heading into some sort of banking crisis, dislocation, systemic issue, however you like to put it. Mm-hmm. So that, to me, my mind, was the importance of that occurrence. And it also happened at the time when international trade more or less crashed off a cliff because of the trade dispute between America and China. And, various countries were beginning to go into recession. Germany, for example, whose major trading partner was China, entered a recession. And this was, so, there were ramifications of what had been happening. And furthermore, it was after about 10 years of a credit cycle of bank credit expansion. And it was clear that that was very, very mature and likely to end. Now, the problem is that when you get an end in the credit cycle, you are, as often as not, it happens actually quite suddenly, and banks have liquidity problems. So that September, did it mark the end of the expansion of bank credit? It probably did, though it's difficult to say that that's the case by looking at numbers such as money supply numbers and so on and so forth. This is the sort of thing that comes out of the woodwork after the event.
Yeah, and it seemed to me for the longest time we Americans could live beyond our means as long as we could depend on the kindness of strangers, is the way it was put. The exporting nations, the nations that had lots of dollars from their net exports, would just recycle them into treasuries. But it seemed to me that that back in September that was part of the issue, that there was, and you point to the trade dispute between China and, a lot of different issues coming together there. But would you say that was really starting to come into play where America maybe could no longer depend, especially at these interest rates, could no longer depend on the kindness of strangers as we once did?
Yes, that's undoubtedly true. The foreigners maintain very large dollar investments. Now, the reason they fundamentally do that is that they look ahead, if you like, to the trading relationship with America from their point of view. And if they see it expanding, then obviously they're going to want more dollars, which they hold in the form of cash through corresponding banking networks. They hold it in the form of investments in U.S. Treasuries, portfolio investments on the stock market, and so on and so forth. So you've got a full range of securities. Now, over time, this has actually built up to a huge number. We're looking at about $21 trillion worth of securities, and by that I mean equities, bonds, and so on and so forth. And then you've got, on top of that, you've got a further 5 billion odd of bills, which include treasury bills, commercial bills, and so on, and also bank balances, bank deposits, which are all reflected in the banking system in New York. Now, as soon as you start saying to these people, look, the outlook is that trade is going to contract, then at that stage, they begin to think, we've got too many dollars for our future requirements. So at that stage, they start lightening up. And you can see that, it didn't hit the markets initially, but certainly we've seen the dollar really tank from that March 23rd high when it peaked at 102, and now it's down about 10%. So, the foreigners are beginning to sell, and that is a bit of a headache for the Fed trying to fund a ballooning budget deficit.
And Michael Oliver told us in the first segment today that if we see 91 on the dollar index, his technical work is suggesting that we could be looking at 84 fairly quickly. So that would be a huge decline in a fairly short period of time. So, if going back to September was sort of a canary in the coal mine, so to speak, I think you maybe have spotted another one in the GCIPs. That is the what you call the what's the acronym stands for globally systemic important banks or something like that, right?
Yeah, absolutely. It's global systemically important banks, and they're required to hold an extra level of liquidity compared with a normal bank, because obviously, the lesson, if you like, that was learned from the great financial crisis was that if a big bank it needs to be rescued, you got real problems. So the answer was that these banks need to have at least a cash cover for at least 30 days commitments going forward, looking out, if you like, from on a day-to-day basis. But the GCIPs actually have ended up, the American ones are by and large in pretty good condition. There's only one which is a bit questionable, and that's Wells Fargo. But if you look at the European banks, it is actually frightening. The Societe Generale has a price-to-book ratio of around about 18%. In other words, investors are valuing the equity in that bank at less than 20% of book value.
Wow.
Now, if you apply that, bearing in mind that what the regulators look at is the relationship between total assets and balance sheet equity. But if you see that the market is valuing that balance sheet equity at only 18% on a price-to-book level, then you've got a new level of leverage which you've got to really consider. And in the case of Societe Generale, that is around about 115 to 118 times.
Gee.
What that means is that if Societe Generale has to write off a euro, the effect on the equity, if you like, is like 118 times on the value of that equity. Equity is priced in markets, so we're talking notionally, obviously. But you can see that the markets are in effect saying that there is a huge question mark over the future of Societe Generale, Deutsche Bank, Groupe Crédit Agricole, and in the British ones, Barclays. And we've got another problem, and that is with America roughing up Hong Kong. We've got Hong Kong Shanghai Bank and Standard Chartered, and their shares are at their 52-week lows, which is the other thing which I look at. If shares are hitting their 52-week lows, then there is trouble ahead.
Yeah, and they've hit their 52-week lows while the indexes, at least, are hitting new highs in the U.S. We know there's just a few of the tech stocks primarily that are responsible for that, and the market isn't nearly as healthy over here. The equity market is healthy as it appears to be based on the indexes, but nonetheless, the fact that the banks are doing so terrible, so much worse essentially than most other equity market participants, right?
Yes, that's correct. There's also another worry. The big Chinese banks, there are 4 Chinese banks listed in the GCIP list. And there was a very strong performance in the Chinese, the Shanghai stock market, really running up to a peak, I think, on about the 7th of July. The banks initially went with it, and then their share prices collapsed and went all the way back. Now, I don't know what that's telling me. I mean, we either love or hate the Chinese, but the Chinese government, if you like, controls those banks, yet the share prices pretty much collapsed. So, does this tell us something? I don't know. I mean, the point I'm making is there is a lot of systemic risk around, and I don't think anyone is paying attention to it.
Well, it wouldn't be a mystery why the markets might be looking at these banks and thinking that, that their balance sheets aren't reflective of their true health, because I think what you have, I don't know if you would call this a depression. It's certainly a global recession with the COVID-19 on top of the other issues that you talked about. So why wouldn't there be massive losses, bank losses? And all these banks are leveraged to the hilt. So, I mean, it just seems logical that why would you want to buy bank stocks right now unless you really are confident that the central banks can generate growth, through monetary stimulation, or you buy those that are going to be protected by the too big to fail banks, right? Maybe that'd be another reason to own them, but
no, it is extremely dangerous. I mean, I don't think I would own any bank shares at all. I'm not giving investment advice. No. This is my personal view. But what I am actually more worried about is, where I have my money deposited, which banks are safe. Now, there are small depositor protection schemes and all the rest of it. But, if let's say you've sold a house and the lawyers are looking after your money in their client account, that is not protected. So there are loopholes in this, which you could find out the hard way. And this is not a nice situation.
No. All right. Well, let's go on to another topic. You've looked at March 23rd. If September was a really important point in terms of that, in terms of the repo market, March 23rd you've pointed to as a very important date. Talk about that, if you would, please.
Yes, indeed. I mean, your listeners may remember that the market tanked in the first 2 months of this year, and in fact, the S&P lost fully one third of its value. And then the Fed came out on March the 23rd, which was a Monday, and made a statement about what they were going to do about it. And basically, they said, we will do whatever it takes to rescue the economy. And this was just literally as the lockdowns were more or less happening. I think in this country, that was the date of our lockdown. And all the markets turned on a dime. They really did. You found that gold and silver suddenly started shooting higher. I mean, particularly silver. The gold-silver ratio started to collapse from 120. 125, I think, and it's currently looking at 69, 70, something like that. And presumably it's got further to go. Copper, the price of copper shot up. The price of oil has also shot up, though there was an interruption in that, because if you remember, there were these delivery problems on the April contract where oil was being delivered and people were long of oil and they had nowhere to store it. So the price went negative. Yeah, but apart from that, I mean, the oil price has gone up quite substantially. Stocks the S&P turned round, and having lost a third, it has now regained all that and some. And as you point out, there are elements in that are really performing. The tech stocks, but it was a big moment, and we knew at that time that the Fed would do anything in its power, basically, which means that it would print money, even go into negative interest rates if necessary, etc. It would do absolutely everything it could to rescue the economy, to stop it going into a recession. And since then, of course, we have had massive monetary inflation. I was looking at the narrow money, M1, that statistic. And basically, from around about February, late February, in other words, just before all that happened, it has been expanding at an annual rate of 60%.
Wow.
Now, this is quite something. I mean, ahead of the Lehman crisis, the expansion on that money supply was about 8.8% per annum. That's it's just a simple calculation. Following the Lehman crisis, it was 16.6%. In other words, it pretty much doubled. Now we're on 60, and not only that, but we have got yet more monetary expansion to come, simply because, as you point out, the economy is really very badly affected by COVID. You've got supply chain failures, the whole thing. The Fed is going to try and rescue the whole US economy, and also, on top of that, the global economy, though they won't quite admit that. Yeah. So you can see that the amount of money printing that we're going to see in the coming months is going to even eclipse that increase of 60% that we have seen in the first half of this year.
Now what happens if we start having these banks start having problems, and then they have to bail the banks out and print more money for that? So it's very frightening in a way. I want to ask you about Jackson Hole, the speech by Chairman Powell, and I understand, should tell my listeners again, remind them it's goldmoney.com for Alasdair's essays that come out every Thursday. Alasdair, I understand you're going to talk about what Chairman Powell had to say at Jackson Hole. Just explain to us why that's important, and give us a little hint about what you might be writing on Thursday.
Yes. As I'm sure we're all aware now, Powell, at his virtual presence at Jackson Hole, shifted the goalpost slightly. Instead of a dual mandate, watching inflation, trying to keep that at around about 2%, and the unemployment rate, watching that and trying to keep it at a maximum level consistent with an inflation rate of 2%, he's basically said that we're going to give more leeway on the inflation rate and concentrate on ensuring that people keep their jobs. Now, the problem I have with this is that the inflation rate which he's using is basically concocted by the Bureau of Labor Statistics, and it says it's around about 1.6%, and it's been running at that sort of rate really for the last 10 years on average. So now, if that was the case, I would have no concerns. But you have got in America two wonderful people who actually calculate this independently of each other. You've got the Chapwood Index, and you have got John Williams, who I think you've had on your program.
Yes, absolutely, several times.
At Shadow Stats. And basically, I think I'm right in saying, I don't want to put words in his mouth, but I think John Williams calculates that on the 1981 basis of calculation, in other words, before they started mucking around with the numbers, the rate of inflation since the Great Financial Crisis, after an initial dip, has been running at somewhere between 7 and 10%. The Chapwood Index, which examines the prices of 500 commonly bought goods in 50 cities, so that's 2,500 data points every 6 months, has come to the conclusion that, and there's quite a bit of variance between cities, incidentally, but in rough terms, over the last 10 years, the inflation rate has actually been around about 10% on that basis, year in, year out. And in fact, on the most recent figures, which are up to the end of June, it's actually picked up a bit. And so inflation is picking up, if you like, on that level. So we have a situation where Chairman Powell is now saying he's going to downgrade the inflation, the importance of inflation, working off the BLS figures, 1.6%, when actually, if you look at the US economy, the real rate of price inflation has been running at closer to 10%. Now, this basically means that the US economy has been in a slump ever since the Great Financial Crisis. Now, this is terribly important because the only thing that has offset that has been the inflation of financial assets. So, we've all enjoyed lovely share price rises, bond yields have been kept low, which means bond prices are high, and so all those wonderful things if you have a lot of money and you play the stock market.
Right, exactly.
But for the guys in Main Street, and particularly, the poor, the elderly, and the underclass. I mean, is there any surprise you got right? I mean, this is quite simply appalling.
It's devastating. Unfortunately, we're just about out of time, Alasdair, but I would say that is just, Powell is just being consistent with what he said back in March 23rd, then I guess you would agree, and that they're ready to let inflation run hot. Do you think they really believe the 1.6% the 1.6% inflation rate? We do have to run, but just your quick thought on that.
Yes, I think they do, because they have got no option but to believe in it. That is the problem. They have to believe it, and we all have to believe it, because if you actually take seriously what Chapwood and John Williams are saying, your economy is screwed completely.
Exactly, and so we would do well not to believe it. And, people on this show know what they're supposed to do with their loose change. Alasdair, thank you so much for being with us again. We're out of time. Never enough time with you, but thank you so much.
That's my pleasure.